Hi, this is Tony Sagami for Uncommon Wisdom Daily. I always say that when investing in U.S. companies, you need to look for ones that have a viable, effective China strategy, and to stay the heck away from those companies that compete directly against low-cost Chinese competition. A perfect example is Dell. The PC makers was one of the biggest stock market success stories of the 1990s. Its stock went from a split-adjusted 6 cents a share on January 1st, 1990, to $51 a share by the end of 1999. Thousands of Dell employees turned into multimillionaires, or Dellionaires as they called themselves. I was living in Austin, Texas during those Dell heydays. I saw those people driving around expensive sports cars and six-figure cigarette boats. They lived in homes that looked more like castles, drank only the finest wines, and they adorned their trophy wives with Rolexes and diamonds. But times have changed. Dell is no longer the kingpin of the computer industry. As a matter of fact, it's fallen number 3 behind Hewlett-Packard and Lenovo. In Dell's most recently quarter earnings report, it reported $635 million in net profits. Pretty good, but that's 33% lower than the same period a year ago and well below Wall Street estimates. Sales and profit margins are also shrinking, and more importantly, Dell warned that the current quarter isn't going to get any better. And it's hard not to see why. Dell is trying to compete against several Asian rivals, including Acer, Ostec, and the aforementioned Lenovo. Now, Lenovo's strategy is pretty simple. It wants to protect its current market share in established markets, and they want to attack new markets while achieving balanced growth in all geographies and customer segments. And it's been remarkably successful at doing so. In the most recent quarter, Lenovo reported a 54% increase in sales and a 73% increase in profits for the full year. On a global basis, its PC shipments increased by 35%, and its market share now is at a new high of 12.9%. As expected, Lenovo is doing very well in China, but its growth in Europe and North America are even better. Sales in those markets jumped by 85% and now account for 45% of Lenovo's total sales. The bottom line is that Lenovo is doing great, while Dell is sinking like a stone. But that shouldn't be a surprise to you if you've been paying attention to my recommendations. Almost 2 years ago, I said to avoid Dell when it was at $13.52 a share, and instead buy Lenovo when it was 57 cents a share. Since then, Lenovo is up 53%, while Dell is down by 8%. Now, I'm not recommending you rush out and buy Lenovo at these prices. My point is that you should always take a close look at your U.S. stock holdings and figure out whether they're successfully selling to China or competing against China. That one simple test will improve your investment results immediately. I'm Tony Sagami for Uncommon Wisdom Daily. Thanks for watching.